Yes, so just the agenda for the day. So we'll talk a bit about the CEO transition. I think it's important. Then we'll go through the figures. We'll do a strategic update for all of you. We'll go through the clusters, and then we'll look at the outlook. So that's the agenda. So just on the CEO transition, the transition happened on the 1st of July, and we felt that it was important to share a bit with you. And I would like to wish a warm welcome to Jean-Pierre Dallet, who is with us today, our Vice Chairman, and will really lead the group until the 30th of June 2024, and where CIEL today is on very strong foundations, and we can really look at the future with confidence and ambition. So I would like to thank you, Jean-Pierre, on behalf of CIEL, and it's really motivating for us to take over and lead the group forward. So I think that on that note, the transition really went through in a spirit of continuity of what has been achieved. And so I'll talk to you to some points, but really the spirit of continuity is important to us. So portfolio management, I think that the focus of the group has really to be on the growth of the portfolio management, on our portfolio. And this is going to be the case going forward. So that growth will happen through our clusters. That growth will happen through organic growth, but also through acquisition. I think that the group has been very successful in M&A and acquisition in the past, and we are really now well positioned to keep growing the group. At the same time, the success of a group has been based on a very strong financial discipline, and we will remain very focused and disciplined in our capital allocation as we drive the growth of a group going forward. So on that note, from a leadership perspective, so we structured ourselves in that respect with all the CEOs, the CIEL Corporate Services team, but we also welcome Mark in the group in May, so really to accompany us in the growth of that portfolio. But at the same time, we are very conscious that our good results or performance is based on very strong fundamentals, starting with our purpose for a world we can all feel proud of, and our values, people at heart, excellence at core, ethical and sustainable. And this is really where CIEL, we have a DNA, where we drive our team, and that's really important, and we are in the continuity of that process. Now, regarding the strategic objective, we are also very aligned. We've worked through a strategic process with all the clusters, and I want to share with you that we are very, very much aligned with all the clusters in their growth strategies going forward, and from a group perspective as well. And as we are moving into new markets, growing in India, growing in East Africa, Madagascar, risk management and regulatory compliance is very important to us. So we put a lot of emphasis on that as we are moving into these new markets. And lastly, our objective is to build long-term value creation, and we want to do it by doing it right. So sustainability is really at the center of our strategy. In everything that we do, we have a very clear roadmap. Each cluster have a very clear strategic roadmap, and from a group perspective, we ensure that this is delivered. So moving to the results, so we posted, so you've seen our result this morning, or maybe not yet, you will discover it today. So we've posted 5 billion in profits for the year, and with a sustained EBITDA growth of 6%, earnings per share growth by 6%, and a really strong free cash flow at 4.2 billion, and very strong free cash flow conversion to EBITDA, which Jérôme will cover later. From a cluster perspective, just to introduce the subject, from a hotel perspective, very strong growth in profits driven by ADR. Textile, excellent momentum in India, and really consolidation of the region, really positioned for growth in the future. Finance, BNI Madagascar still driving very strong. Healthcare, driven by leadership in operational excellence, Mauritius is doing well, and we have very good momentum on Uganda as well, which is showing a very good growth rate. And then property, we are starting to materialize the sales of land, so starting to unlock this cash. And lastly, agro, we really benefited from a very good sugar price, which generated strong profitability. So that's it as a teaser, and I'll hand over to Jérôme for the figures. Thank you.
Good morning. Good morning to those online. So as Guillaume mentioned, the results were released this morning. So I hope probably you haven't had time to go through them. And we'll try to give you some key KPIs, financial KPIs, to give you an indication of how we performed during this financial year. So the group revenue has been maintained at 35 billion rupees. We'll explain later on the movement during the year, the variances. The group EBITDA has increased by 6% to 7.5 billion. Group after tax, as mentioned by Guillaume, we have reached the 5 billion level. And the profit attributable has gone up by 6% to 2.8 billion. In terms of EBITDA margin, very good results at 21.3% of EBITDA margin. The earning per share at 1.66 rupee, of course, in line with the growth in profit attributable. The net asset value for the group stands at 13.73 rupees, a growth of 11%. And the last one, which is probably the most important, is the return on capital employed, where we've gone over the 15% mark. And I think last year we said that the target was around 13-14%, so we've beaten our target in terms of return. On this slide, you will have on the left a breakdown of a turnover in percentage terms. The inner circle representing the turnover of last year being June 2023, and the outer circle, the turnover for each cluster. So we can see that there has been a contraction in the textile, going down from 50% of our turnover at group level to 44%. But this has been mitigated by the finance cluster, which has gone up by 9% in terms of revenue. The hotel cluster also did very well, above double-digit increase. So increase from 23 to 25. And so has the healthcare sector also, which has shown good progression and which Helen will cover later on. Now, on the right of the screen, you will have the contribution to the profit attributable for each cluster. And as you can see, the hotel cluster, even though CIEL only owns 51% of Sun, has generated a net contribution just below the 1 billion mark, and is the biggest contributor to the profit attributable of a group. Followed by textile, where we own 100% in CIEL Textile, which is somehow lower than last year, but around 800 million contribution to the group profit. And then the finance cluster, which has really done well in terms of PAT, but we've got a large share of minority interest in Madagascar at the BNI, which then brings down our contribution to around 650 to the group profit attributable. Followed by healthcare at 6% of our total profit, and the property around 300 million of contribution, 360 million, and agro also very good performance, which I will cover later on. Now, this is the same information, maybe shown in bar chart, so we can see the growth in EBITDA from 7 billion to 7.5 billion. We have had during the year a one-off sale of land from Fairney Limited in the property arm, which has generated a profit of 360 million, which has boosted the EBITDA, but also good cost control across the group, especially in the hotel sector, has made that our EBITDA margin has increased to 21.3%. The PAT has gone up from 4.3 billion to 5 billion. There, in fact, we have had lower ECL provision under the IFRS 9 in Madagascar compared to last year. And the share of profit from our associate undertakings has been also boosted during the year by a one-off transaction at Sun level, where we're now recognizing our share of net assets from Limited. In terms of profit attributable, we are at 6% growth from 2.6 to 2.8. That's the profit attributable to our ordinary shareholders. Free cash flow, maybe the most important slide in terms of financial returns for us at CIEL. If we look at the last two columns on the right, we can see that we have raised from operation 6.2 million rupees, 6.2 billion rupees of cash generated from our operations. We have had to cater for capex. This is maintainable capex at just below the 800 mark, higher than last year, which was at 625. And, sorry, this is the working capital, I apologize. Working capital requirement, mainly coming from the property, because the sale of the land, which has been exercised during the second quarter, is paid over 2 or 3 years. So that's what we had a big receivable in the accounts at year end. And that's explained why the working capital requirement has gone to 800 million. Capex has also increased from 1.3 billion for the group compared to 1.1. So at the end of the day, we are very close to the level we were last year by generating 4.16 billion compared to 4.24. Also an important ratio that we are now following closely is the free cash flow to EBITDA. It's our capacity from the EBITDA generated to produce free cash flow. Well, what it brings is we cater for capex, interests, which are not in the EBITDA line, but which are in the free cash flow. So it's our ability to generate cash, and 56% compared to 60% is quite a very good percentage overall. Indebtedness of the group, we can see from the COVID years, has considerably gone down. More so ever that Sun is generating cash and quite substantial amount, which has made it possible to repay some loans, some notes in anticipation. And we're down to a gearing ratio of 25.1%, which is very commensurate and somehow give us the ability and more firepower going forward to be able to invest into new projects. We can see that the total net indebtedness of the group stands at 11.3 billion compared to 12 billion in prior year. This excludes the MIC, which is treated as quasi-equity at Sun level of 3 billion rupees. But debt to EBITDA ratio is standing at 1.5 compared to 1.7 last year. Good news also, which came during the year, is that the share price has performed very well. And in fact, we're beating the SEMDEX. We've since the 30th of June 2023, managed to grow the share price by almost 30% compared to 18% for the SEMDEX. And we can see that there's been quite a good increase since the June cutoff. However, at 8.38 rupees, which was the price last Friday, we still quoted at a discount to NAV of 36%. So there's still a lot of room for us management to reduce this discount and to bring the share price closer to the underlying net asset value of the company. We have also, at this price, at year end, on the price of year end, a yield of 4%. We have increased the dividend payout by 14% in July to 32 cents per share, and we have a PE ratio of 5 times. That's it, basically, for the key financial indicators. Of course, you have the full detail in the average, which has been submitted this morning. And now we're going to cover the portfolio review. So each CEO will be coming in front and presenting their results. I call open, maybe Mark before, sorry, I forgot about it.
Thanks, Jerome. Morning all. So my first time up here. So I'm very, very happy to be at CIEL, and thank you for the welcome, Guillaume. So just from our NAV waterfall bridge, you can see that from FY23 to 24, NAV has grown about 16%, so close to 3.5 billion rupees. mainly driven by hotels and resorts through an increase in the share price of Sun, as well as an increase in the finance cluster driven by the valuation of BNI and Bank One. Textiles increased by 374 as well. Healthcare, driven by the CK VWAP of 258 million. Property, 202 million. And agro, 245 million. And that's resulted in what you can see in terms of how the breakdown is according to the different businesses at CIEL. So the 24.7 billion, driven by valuation of CIEL Textile at 28%, followed by hotels and resorts 19%, property at 18%, healthcare 15%, finance 13%, and agro 7%. And we framed up like a view on our strategic update according to where we're focusing on growth. So my previous life, I was a strategy consultant, and based on the research, you can really see that businesses that successfully grow from an EBITDA profit perspective and then total shareholder returns perspective really focus on prioritizing their core business, expanding geographically, growing through acquisitions while preserving margins and free cash flow margins as well. And just in terms of a brief description of what we mean by core, adjacent, and new frontier. So core is your core business in terms of what you operate in now, and that is core to you. So if I take CIEL Textile as an example, so it's a mature business now. Initially, its core business was in Mauritius, invested into Madagascar, then invested into India, and now it's a stage where it's a world-class business operating its core businesses in India and in the region. And looking at healthcare as another example, its core businesses in Mauritius. From a product or new business perspective, it expanded into adjacency through C Labs in Mauritius, and now it's looking at regional growth in East Africa. And then New Frontier really is around new opportunities in your industry that aren't necessarily close to your core, but that could potentially be growth drivers in the future. So a good example globally is in the financial services industry, where banks have invested into fintechs or taken acquired fintechs or partnered with fintechs. So how we look at, from a textile perspective, from a strategic growth, we're looking at consolidating the region and really focusing organic growth in India. We're seeing a lot of demand materializing with a China Plus One play, and that's a core focus of CIEL Textile, is to really focus on organic growth in India. From a healthcare perspective, we're maintaining and growing our strong leadership position in Mauritius, have successfully expanded into Uganda, and are looking at further opportunities in East Africa to expand the healthcare business. From a finance perspective, we focused on growth and operational excellence of the core banking assets in Mauritius and Madagascar, and really making sure that BNI, we maintain our market leadership position, and also looking to generate new revenue streams through digitalized products and fintech collaborations in terms of the near frontier growth. From a hotel and resorts perspective, Sun Life, focusing on improving the non-optimized assets, which are Long Beach and Arm. And then from a Rivio perspective, really focusing on branded hotels with renovation capex phase to boost the EBITDA. And then from an adjacency perspective, looking to unlock significant value through branded real estate development projects in Rivio. For property, so Evolus, looking to regeneration of non-core assets to enhance the yield and enhancing the yields of existing assets, as well as additional warehousing and office space. And Fene, we're looking to unlock value through the Fene Tropic Agri-Hood project. And from an adjacency perspective, looking at Fene ecotourism development with additional services. And from a new growth drivers perspective, a project we've just launched is using the manufacturing capabilities we've got in India to see how we can broaden manufacturing across India and higher value industries than textiles. So that's a brief snapshot of what the focus of the group is from a growth perspective. And I'll leave it to the cluster CEOs to take you through that in more detail. Thank you.
Good morning, everyone. Well, I think most of you attended our analyst meeting on 15 days ago, so I'll be quite short. The Sun Limited has done a very good year. Revenue increased by 8%, in spite of Shangri-La Le Tourist Rock being closed as from end May. The occupancy was about 73%, at par with the year before, but the ADR has progressed by 12%. In terms of EBITDA, we have a growth of 7%, but the good thing is that we've maintained our EBITDA margin of 30%, similar to last year, in spite of inflations on the wage bill, for instance. So we've got a very healthy EBITDA of 30%. In terms of PAT, we've reached the 2 billion mark, which is a historical record. There is a one-off gain there. It's a reversal of provision from the impairment in East Coast, which is the company owning Arm Hotel. So basically, our gearing has decreased also to 16%, with a very healthy balance sheet. What I'm very glad also is that we have also performed. I'm very happy about the non-financial performance also at Sun, because we've on the human resource side, we have improved our Great Place to Work rating from 65 to 73%. We have also stabilized our workforce, which was quite unstable post-COVID. So it helped us actually to continue to increase the level of service. And we have launched our employee value proposition, which includes 26 experiences for our employee to improve the attractivity of Sun on the labor market. That's very important. In terms of strategic direction for the next financial year, as you know, we have spin off Sun Limited into two listed companies. Well, you will have Sun Life brand and then Riveo brand. I think we have explained this to you in details in the latest analyst. We are still focusing on customer satisfaction, enhanced guest experience, and we are coming up with, by the end of the year, with a new, quite modern wellness concept in all Sun hotels. Increasing the ADR is still our top priority, and we have also, obviously, wage bills increasing quite a lot, but so we are focusing on actually improving the productivity. We have a digital roadmap which is progressing, and we know that we have to continue to increase productivity in the hotel industry as a whole. And obviously, we have also a sustainability roadmap on which we are progressing quite well. And we have won many awards this year, national awards and recognition, which has positioned Sun Life as a leader in sustainability in the hotel industry. And improving the non-fully optimized, because Ambre and Long Beach are now profitable, but they are not reaching the level of EBITDA margin of La Pirogue and Sugar Beach. So we have a good margin there to improve. And the good thing is that, as you know, we have a new partner now that has bought the shares of the previous owner in Ambre. MIC is not our partner, and we have been able to sign a long lease with them now, a long-term lease, and agreed on the renovation which is needed, which will help us to optimize EBITDA margin at Ambre also. On the Riveo side, we are completing the listing of the Riveo, which should happen by the end of this month. And we are finishing the renovation of Tourist Rock, La Shangri-La Tourist Rock, which will reopen on time, mid-October, and planning the four-season renovation, probably for next year. And we have two big opportunities there, because these two new branded hotels, Shangri-La and Four Seasons, are supposed to bring much higher ADR after renovation. And there's a big increase potential here. And on the Revio side, we have also blended residences projects and also a master plan at ILOCERF, which includes Ecolodge, which will be able to actually make ILOCERF a profitable business unit. There it is for Sun Limited and Sun Life. I will take the questions later.
Changer le slide. Tu changes? Okay. Good morning. Textile, another one. Okay, so June 24, we had a drop in revenue, which is actually at the back of the previous year, where we had a big increase in turnover. That was the time post-COVID where the demand was very high, and there was a very high inflation at the same time. So 24 was a year when most of the brands and retailers had to reduce their inventories and where the raw material prices went down. So we have a drop. And actually, behind the 12%, we have two different realities. We had a drop of about 25% in Mauritius and Madagascar, and a slight growth in India. So that's a diverse situation. EBITDA and PAT went down by a high percentage because we had to readjust capacity in the region, specifically to Madagascar. So we had a kind of a one-off closure cost. So looking ahead, actually our order books are now quite full. The situation has stabilized from a retail point of view. The region is stabilized, and it's all about asset yielding, enhancing our OPEX in Mauritius and Madagascar. And the focus is really India. As you see, there's a lot of geopolitics happening around the globe, which is pulling brands and retailers to knock at the door of India, and we are very well positioned for that matter. There is a very dynamic demand happening now, and actually the challenge is to cope up with the demand. So we shall see in the current year potentially a very dynamic growth from the textile, mainly coming from Asia, so which we're really strong about. I mentioned already, so investment in India, consolidation in Mauritius and Madagascar. Just a quick word on Bangladesh. It's small for us. It's only 5 or 6% of our operations, but the situation on the ground is a bit unstable because of political issues, so which is not good for what we have in Bangladesh, but excellent for what we have in India, because people are coming to India. Lastly, we have had for the last 2 years one product category which has underperformed. The good news is the recovery roadmap is happening as per plan, and hopefully we shall see this product category generating positive profitability as from next financial year. Otherwise, we maintain our leadership in sustainability. Over the last few years, there was a high focus on the renewable energy. We have moved from 15% in 2019. We will be crossing 60% of renewable energy now. And we will further invest in photovoltaic capacity in Mauritius and India, which shall bring us to 65–70%, which is way higher than the plan we had initially. Now the focus is on traceability. There are a lot of regulation coming from many countries in the US, many states actually in the US and Europe. And we need to provide a full traceability of what we produce, which is a huge challenge. Because the fashion industry is very diverse. So we have recently invested into a digital platform, which we are busy spreading across our operations to provide the maximum transparency to the market. That's it. Thank you. Short and sweet. So the next one is the bank. So you need to close the financial services, sorry.
Thank you, Eric. Good morning, everybody. So it's my pleasure to share with you a bit of the details in the finance cluster. Another good year of robust results as compared to last year. And I would say trend maintained over the past couple of years. So revenue is up by 10%, driven by the two banks. Bank One and BNI still remain the key drivers of financial performance, notwithstanding that the dynamism has been led by BNI. This has reaped us a EBITDA increase of 30%, concurrent to a PAT growth of 46%. So maybe just to comment a bit on the PAT. So the results have been driven by BNI primarily. We had some stability in the revenue streams of Bank One, but BNI economic environment after the elections has been a bit sluggish, but still we benefited from the pre-election performance, and we are hopeful that we can still maintain the way forward. So going into this financial year, BNI is still expected to be the primary contributor. We do expect a few challenges there. The economic climate remains sluggish, but hopefully we can still maintain the performance. So we are already leading primarily on the loan book, the credit, the primary funding of the Malagasy economy still remains through BNI. We are leading in the loans and advances. We are the highest holder of government securities as at end of June. So we hope to maintain that position and still generate decent profits. Notwithstanding that, regulatory changes in the banking sector is ongoing globally in Mauritius and in Madagascar. So those are the challenges that we need to prepare for. It's very simple from the regulator's perspective. They want just to make sure that key banks are adequately capitalized and doesn't create any shocks to the market should there be a weakness in the economic environment. Pursuant to that, Bank One, we are looking for a higher expectation financially, but also in terms of offering. And it kicks off imminently in October with a change in the leadership. So the previous CEO, Mark Watkinson, has retired in August. And we have announced Sunil Ramgovin as the forthcoming and incoming CEO starting in October, in a couple of weeks. So that is going, in my opinion, create another look and feel of Bank One, hopefully, and a strategic direction which is expected to provide incremental revenue stream. Across the board, I mentioned it on Bank One, but across the board, we want to maintain and improve on client experience. It's critical, in my opinion, given the fact that in financial services, you exist because of the client existing. Otherwise, there's no business. So customer experience is something that which will anchor all our activities beyond financial performance at all levels, be it in BNI, be it in Bank One, Midco, and other investments that we are contemplating. Moving on to Midco, beyond the client experience, we also want to consolidate our focus on certain what we call segments. So corporate services, private clients and funds, or more specifically in some instances, special licenses that have been rolled out by the FSC is something that we want to look at and consolidate for. We have also recently, just after the financial year, made 2 investments in what I would say fintechs, both based in Uganda, and we are looking to build a portfolio there. Hopefully it complements and accelerates some of our journeys within the bank. It's not a sine qua non condition, but this will be a bonus if we can bring these solutions into the banking environment and, if possible, into the Midco environment. So all set, and I think we should have another good year and hopefully a better performance from finance into 2024, 2025. That's it on my side. Look forward to your questions later on. Thank you.
Hi, everyone. Very pleased to be with you this morning. So on the healthcare, last year was quite an interesting year for CIEL because it was the first year with our competitors full in place in Mauritius. And we were very pleased to see the resilience and I would say the growth of CIEL Mauritius despite this new environment. And as you can see, be it in Mauritius or in Uganda, we have achieved an 18% growth on our top line. We've also an EBITDA growth of 15%, yet the PAT was at par, mainly due to, I would say, a higher depreciation level, which is in fact the results of all the big projects we had started in FY23, for the one who were there, the cancer unit in CIEL down in Floréal, and CIEL Grand Bay. These were the two main ones, but there were a lot of projects. So indeed, we are having now a higher depreciation, but yet a better tool for the coming years, so we are very excited. Also, we had some exceptional expenses linked to the opening of our office in CIEL, Kenya, and also the acquisition of an asset that we did in Madagascar. So those ones were one-off for the year. So quite, I would say, happy and to see the resilience and the growth of CIEL for last year. Next year, in Mauritius, patient experience remains our big focus. From Mauritius is also to benefit from all the big investment we did in the 2 previous years so that we can really, I would say, milk those investments. Also, we are adding new rooms in CIEL Wellcane in Grand Bay and continuing the renovation of CIEL Dane so that we would be at the end of the year normally fully, I would say, well set in Mauritius. CIEL also continue its growth, be it in Mauritius but also in the region. So we are very happy with the performance of CIEL. We have renovated our C-Pharma, so that's a retail pharmacy. So we are really getting the benefit of what we have started last year. And just for the one who don't know, but in Uganda we still have like 23 dispensaries. So it's also C-Pharma is also in Uganda. Our medical hub, we are investing in making sure we are really servicing the region as a medical hub, the region of the Indian Ocean, but also the region of East Africa. So this is, medical hub is towards Mauritius, but also in Uganda from the countries around. Our East Africa expansion remains our, I would say, our excitement for the coming years. We have done a good strategic session with international consultant, reassuring us on how we were positioned compared to the international players. Yet CIEL is still smaller than the big one, but getting there. And we are committed for the next 5 years, very excited about it. That's the reason why we opened our office in Kenya. Clinical education is also something we are working hard on and starting our school in Mauritius in October, and at last continuing to invest in our people, in the sustainability, because as a healthcare provider, obviously our social impact is important. So I think I said everything, so I will be very pleased to take questions later on.
First of all, to begin with, just as Guillaume has thanked Jean-Pierre, I would also like to thank Guillaume. It's my first analyst meeting, and I would like to thank Guillaume for the trust and taking over the CEOship since January. For the property sector, Guillaume has laid a foundation for the development of the property sector, and we are now continuing and consolidating that strategy. As Guillaume mentioned, for FY24, the main driver of PAT was the sale of land, which has boosted revenue from FY23 to FY24. That sale has given us the firepower and the cash to be able to pursue our strategy in terms of property development. I would like maybe to focus on two items. We want to consolidate now Evolis and Ferney as very strong brands to be recognized on the local market. Evolis has reached a very stable level, and we still want to continue the growth through organic and through performance delivery of the Evolis vehicle. And you will also hear a lot about what we've written here, Ferney Tropical Agri-Hood, which is what we want to promote as the tagline for Ferney as our brand. So Ferney today is well poised to continue its development. We are starting infrastructure works very soon in the few weeks to come, with our first project also starting this year. Our focus will be on unlocking value for the property cluster. We have, as you've seen, a big asset base, but a lower share of the profitability. So our focus for the next years to come will be to unlock the value through the growth of Evolis, through the property projects at Ferney, and through an ecotourism strategy at Ferney. All this, of course, will be in line with the sustainability roadmap and strategy of CIEL Group, particularly our cluster, and to maintain also the very beautiful site at Ferney. So we are pleased also to announce that we have also won some awards in the sustainability sector, both at Evolis and Ferney level. So that's it. So I hope you will keep on watch for Evolis and Ferney, and remember the Ferney we want to develop with a very meaningful purpose, and we have adopted as our tagline, pioneering meaningful destination. Thank you.
Okay, last but not least, the agro cluster of CIEL. So CIEL, through CIEL Agro, owns 21%, just short of 21% of Alteo and Miwa. Therefore, we don't consolidate those two companies. We just take, as far as the P&L is concerned, a share of profit. It's an associate undertakings. I believe you've already gone to the Miwa analyst meeting, which was last Thursday, and we are having the Alteo one tomorrow. But just to give you the main highlights, so in terms of contribution to the group profit of CIEL, we're just short of 4% compared to last year. We were at 306, and we're down to 293. The main reason was, even though it's a very good performance, because Alteo made a record profit of 1.1 billion rupees of profit attributable, where the shortfall comes from is from Transmara and TPC, our Miwa ventures in East Africa. As we can see, the profit, our share of profit has gone down from 106 to 76, but very much compensated by the performance of Alteo. So what was the challenge in Miwa? It's mainly the cane supply at the mill, whereby in Transmara in Kenya, we had a shortfall from our outgrowers. And at TPC, climatic conditions have been really, really poor during the harvest season, a lot of rain. And this coupled with a factory breakdown, we had some issues at the turbine there, led to results which were under par compared to the prior years. On the other hand, Alteo, despite the fact that from the property side, the Alteo project, the IRS project at Anaita has come to the end, so meaning all the plots have been sold. So there was a reduction in terms of contribution to Alteo's profit from the property cluster, but we had a record year in terms of sugar price. I mean, I'm sure you're all aware, we got 31,000 rupees per ton, which is a record-breaking one. And unfortunately, we foresee for next year a reduction in this price. The indication from the Mauritius Sugar Syndicate will probably be around 24,000. So it's a reduction of 20% in the revenue stream. Alteo will focus next year on its new project, a sustainable smart city project, just at the back of Anaita, around the sugar mill. They've already launched the sales of the first phases very successfully. So this is going to be the main property development from Alteo. However, they're also doing a lot of projects across from the north, near Montpiton, to the south, east, whereby there will be a residential development project, be it commercial ones, residential, which will be incorporated into the strategic plan. On the agri side, we need to, labor shortage is an issue, especially with outgrowers in Mauritius. They can't sometimes find cane cutters. So this is really, really a challenge in the industry. As you can see, in the agriculture, we've said the mechanization is key. So today, Alteo has reached around 75% of its total cane under cultivation are mechanically harvested. The aim is to rapidly reach 100%. And of course, from the energy front, we are considering to have more and more biomass, green biomass, to substitute to the coal. This is the target which we have aligned with the state to be able to move away from charcoal. So that's really the main highlights from Miwa and Alteo. And I'll pass on now to Dev, who's going to cover the ESG.
Thank you. Good morning, everybody. So pleased to be here to give you some update on the ESG front. Guillaume mentioned this morning about our purpose, for a world we can all feel proud of. So this actually really guides our commitment to sustainability and our continuous improvement mindset that we have. So just to share with the team, as you're aware, we had launched our strategy in 2020. And we felt it was time for us also to do a review. So in 2024, we conducted a review of the strategy, obviously to take into account the evolving economic, social, and environmental landscape, just to make sure that we are leveraging on all the risks and opportunities that is coming through, but also ensuring that we are in line with upcoming regulations. I think what was very important as well for us was to ensure that in terms of our KPIs that we have defined as a group, that it remains relevant for the group and the cluster, given the diversified nature of our activities. So as of now, the group has now identified 17 KPIs that we are focusing on, really for us to have probably more impact on all the 3 pillars that we have defined for the group. Just to highlight that, for example, on the environment front, key focus is on transition to renewable energy. We aim to achieve 80% by 2030. There's also a big focus on reducing the impact of biodiversity loss, especially for our projects at Fernie. On the community side, the whole idea is also to ensure that all our investment is really focused on long-term rather than short-term. And then on the social front, the idea is really to focus on a great place to work. You've heard it from some of our colleagues, so we really want to be certified as a great place to work. But very important as well is our focus on diversity and inclusion as well. So that remains a key focus for us. As a group as well, we have adhered to the UN Global Compact recently. This whole idea is for us also to align to the 10 universal principles, which is on on environment, anti-corruption, labor, and human rights. I think we are already aligned to all of those. The whole idea is for us to be part of the UNGC is also to leverage on the regional and the international networking possibilities that we have, just to help us also to better achieve or to accelerate our achievement of our KPIs. Then, as we announced last year as well, we have embarked on a data journey as well. So I'm very happy to say that, in terms of our data maturity across the group, it has improved significantly. As we shared last year, we have implemented the UL 360 tool, and we have made great stride across all our clusters. And, we are really improving on the whole data accuracy and reliability for the group. The most important point when we look at UL 360 is that it's also, a compliance and reporting tool that will allow us as well to be in line with global reporting standards, but also, with upcoming regulations like the ISSB. So that's it in terms of the progress. Then, obviously, we've heard, all our clusters sharing about the achievements. So really, we are making a great headway. So you can see there all the different accolades that we've received. So just quickly, if we breeze through, if you look at the textile business, for example, a number of factories have been recognized as sustainable factories. We already have 5 factories which are LEED Platinum certified. And most interestingly as well, CIEL Textile has also signed up to the SBTi, the Science Based Target Initiative. So we have now a clear emission reduction roadmap for CIEL Textile. CIEL Hotel and Resort, François mentioned about the awards as well. So 2 years in a row being recognized by the Tourism Authority, which is great in terms of the commitment to sustainability. Sun now, all of the hotels are zero food waste to landfill as well, which is a great milestone. And there's a great commitment as well to, to community empowerment and marine conservation. On the healthcare side, also the One Life, One Tree has been launched for some time now and has been recognized in Uganda, for example. They won the Excellence Award for Sustainability. Property side, Jean-Noël just mentioned, I think great progress being made on the conservation and reforestation at the Fairney side. And on the property side, I think one of the flagship projects we have is at the Nouvelle Isle, where we've been really optimizing resources and repurposing as well the old L'Oréal Knitwear factory. CIEL Finance as well, big focus on operational excellence, delivering great customer experience, as Lakshman mentioned. And there's a lot of effort as well also to increase accessibility to customers as well. So all of that to say, just to conclude that, a lot of the work that we're doing is being recognized. I think it's testament to the CIEL Group commitment to have a positive impact on society and the environment. I think if we look ahead, as Guillaume mentioned, we've got a very clear roadmap. We are very confident we will deliver on all our KPIs by 2030. And, as a business, we will continue to, benchmark ourselves, look at best practices, and lead the pack and be a leader in sustainability. Thank you.
Thank you, Dave. Thank you very much. So now we'll talk a bit about the growth. So when we look at the growth, always good to look at the past. So where we started and where we are. So what we wanted to show here is a bit the story of the portfolio. So in 2014 and 15, we took position in CIEL Textile, in Sun, and CK as well. We bought Uganda. So really consolidation of the portfolio, taking position. Then 2016 and 20, we really focused on the portfolio and the growth of that portfolio. Then COVID came. So we had to restructure further. But then we came out of COVID very, very strong. So where we were able to really accelerate the growth of a portfolio. So what does it tell us? It tells us, so we look at the CAGR, the compound annual growth rate, from 2016, because 2014 and 15, there was a lot of portfolio movements, so which distorted the figures. So we are on a CAGR of 23%, 2016 to 2024. And then coming out of COVID as really strong, with a CAGR of 65% on EPS. So this is important for us because it's growth with substance, what I would like to say. It's long-term value creation. And most importantly, we have been able to deliver that growth with a decrease in gearing. So really strong financial discipline, good capital allocation, good acquisition, and driving this acquisition. So on that basis, we look at the outlook. So for us, we really want to continue to deliver a long-term value creation over time at the EPS level. I think that we want to do it with substance. So we've shown that we've done it in the past with substance. We are focused on our clusters, but we want to identify new growth drivers as well to be able to keep that growth in EPS. The second element is we want to narrow the discount on net asset value. And I would like to say that we believe in our net asset value. So we work to grow our net asset value. It's not just an accounting figure, because we look at the portfolio from an investment mind perspective. So we are really focused on how we can keep growing that portfolio and keep growing that NAV going forward. But again, over time, with substance, with a strong financial discipline, with a gearing which is well under control, so that we can take opportunities when we want, and we can also absorb shocks which may happen in the future. Then from a growth perspective, we talked about it, but really the textile operations in India is giving us a very interesting and very exciting playground for growth. So organic growth, we have already invested into the factories, and we are in a position today to really materialize the move towards India and look at the future in India. We employ 10,000 people, close to 10,000 people in India today. So we have many factories, we are well established in Bangalore, and we are going to leverage on that position. Ellen talked about healthcare in East Africa. I must say, going to Uganda and see what we are doing there, extremely exciting. So we want to really focus on building that healthcare hub for East Africa. Very clear strategy, great team, and very focused on doing so. Continue to optimize the yields on Sun Life. I think that what has been achieved in the last 5 years by the François and his team is really exceptional. Today, low gearing, high yield on asset, but still many opportunities. We talk about Long Beach, we talk about Ambre, and then on Riveo as well, post-renovation, real estate. So we want to keep focusing and be open to opportunities, at the same time making sure that we are yielding our assets post-COVID, which was a tough time, of course. And then we, on the property side, Jean-Noël talked about it, we feel that there's a lot of value still locked into our NAV in the property. So we are working on that, but really with a mindset, how do we yield and how do we unlock that value? And then with Mark and the team, really to expedite our growth drivers and manufacturing in India, in, I would say, higher valued manufacturing than textile, is we are working with some good opportunities that we are on it at the moment, and we are going to drive for that. And also East Africa on the fintech, Lakshman touched about it, leveraging on our core in Mauritius, Madagascar, and see what we can do in the region. So that's a bit the way forward. Happy to take questions. I think that we have a great team, all very motivated, strong balance sheet, and good momentum. Thank you very much.
Right.
Yeah.
Question? Any questions from the floor?
Thank you. Question on textile operations. What India represents today in terms of turnover compared to the other jurisdictions where you are present? And within India, how much do you sell to the local market and how much internationally?
Yeah. So India today is close to 50% of our total turnover. And in our turnover from India, there's about 20 to 25% which is meant for the domestic market, where we mainly supply international brands, Lacoste, Hugo Boss, who are growing. Ralph Lauren as well is going big time in India. So all the big brands, obviously, who have invested a lot in China over the last 20 years are now looking at India. So there is a huge opportunity. Right? It's today about $35 million turnover in the Indian domestic market. Guess what it will be in 10 or 20 years. And actually, we're not pushing. The brands knock at our doors and they just grow and we just supply. So it's going to be, over the next 20 years, a big growth driver. So the rest, 75%, is to export. So mainly to Europe today, but there's more and more which is going to the US. Polora has become one of our key customers over there. I had the pleasure to welcome the CEO who visited us recently. But we're seeing Japan as well coming to us. So many Korean people as well. So everybody's looking at alternative to China, which has been a dominant force. There's been a lot of move to Bangladesh, mainly from European brands, but looks to be India time. So the good news is we went to India for the first time exactly 20 years ago. And today, in our product category, especially woven shirts, by far, we dominate the market.
I had a quick question for Hélène. Bonjour.
Ah, salut.
Ça va? I'm looking at CIEL. You guys have made a lot of, strides. Looking that you're looking to expand in East Africa. One thing we've noticed, though, is, there used to be, I would say, many smaller hospitals. And then, by happenstance, CIEL became, one of the major players about a decade ago. And now we're seeing a lot of new hospitals coming online. So how is CIEL responding to that on the domestic front?
Yes, well, we believe that there will be a shift indeed. There's still a lot of small ones, and they might suffer because healthcare is a volume business. In fact, in the sense that the quality comes with the volume. Usually we say in businesses, quality is with lower volume, but in healthcare, the more you do, the more your doctors are exposed to cases, the more they are trained, the more they have colleagues, etc. So we believe that in fact quality is coming with size, and that we are very well positioned for our doctors to feel lift up when they are part of CIEL. In fact, there's one to come, another competitor to come, but not that much that officially are coming. So no, we feel that we have done everything we had to do locally by investing, as I said, quite heavily over the last 4 years, and with an acceleration in FY23 and FY24, so that we are super ready. Healthcare is a long cycle for someone who starts. It's a long time returns, so it won't be easy for the newcomers, and we are very humble. We are still working on improving our quality, our patient experience. Yeah, we are jogging and others are starting, so let's jog and run faster. That's the only thing we have to do, and we'll do it.
Maybe one question from a group perspective. Wondered if you could tell us how you look at it in terms of split of profit inside of Mauritius and generated outside of Mauritius, and given the strategies that Mark has outlined, where do you see that going, let's say in the 3 to 5 years?
Yeah, maybe just from a profit perspective, I don't think that we need to say, okay, we want to limit the profit in Mauritius, or what we want is really to optimize and yield the opportunities. Having said that, we see the growth much more outside Mauritius than in Mauritius naturally, and we are very well positioned for that. So when we look at the potential in India, and we look at the potential in East Africa, certainly we believe that the profit of a group outside of Mauritius will keep increasing, if I put it that way. Textile in Mauritius has reduced significantly. So now we are more in Madagascar and in India. So this will materialize into the figures. But I don't think that we need to be focused on how much profit we are deriving from which country, but it's more about the opportunities for the business. We feel that in Mauritius there's still very good opportunities from Sun Life perspective, very good opportunities. We can derive significant profit in Mauritius from the real estate development, for instance. So all this might change a bit the balance. So we are more focused on this. Now regarding the group in the next 5 years, I think that for us, in our clusters, we have underlying growth opportunities. So we don't need to go and invest and do big acquisition outside to really bring that growth. Having said that, so we want to, you've seen 20% CAGR. Obviously, we want to keep driving best-in-market growth, do it the right way, long-term value creation. So I would say that India in 5 years down the line, East Africa, being on the healthcare and financial services, and manufacturing in India should be a big part of a group. Réponse un peu diplomatique, mais voilà.
Any other questions from the floor?
Maybe one point that I didn't put in the presentation, but from the NAV perspective, we are also very conscious that we are facing some market inefficiencies, okay, where we are in Mauritius. And it's true that more we operate in India, more we operate in East Africa. From a management perspective, we are really focused on maximizing net asset value on the market where we operate. So this is a focus from management as well that we have clearly in mind.
Thank you, Guillaume. We have one question from the online audience, from Keshav Magoo. Hello. With regards to textile, you mentioned that there was a decline in Mauritius and Madagascar. Can you please expand on the reasons behind this? You also spoke about the bright outlook in India. Are you considering reallocating more capital towards India to benefit from the tailwinds there in the form of M&A and new factories?
Okay, I will stand up now. Now for Mauritius, Madagascar, actually there's been a drop in the worldwide demand. We saw that the imports in the US and Europe dropped by 15 or 17% in value in 23, which has obviously impacted us a lot. Now the impact was more into Mauritius and Madagascar. Clearly it's India or India sub-region time. So there is a high focus on relocation of sourcing in India, in the India sub-region. And Mauritius, Madagascar being isolated, combined with some logistic challenges with the Red Sea, didn't help. So on the way forward, we're seeing still a good momentum. Anyway, it's all about cycle. So it's India today, it will be Africa one day. So we know India will grow fast, and what's happening to China will happen to India one day. So we want to ensure we are, just like we went to India 20 years ago. So for many years, people are saying to us, why do you go to India? Why don't you invest in China? And we always said we want to be ready when it will be India time. So we still want to invest in Madagascar because it will come very soon as well. So now for India, we'll be exploring different avenues. The focus remains on operational excellence. We are in a highly competitive industry, and we need to ensure we deliver the best services to demanding customers. We're not positioned on the mass market, we position on the high brands. Therefore, if we grow by 5%, we need to employ 1,000 fresh people. So it takes a bit of time to scale up our own capabilities. So we'll focus on organic growth, but if we see some good opportunities to expand activities across India and accelerate, that's something which we may be doing. Obviously, it's a huge playground. It's a massive country. I mentioned the local market opportunities, but clearly there's a lot more we can do for the export as well. So despite the drop in our turnover this financial year, I see a huge potential for us in the coming years. Actually, it's a balance of the big leaders in our industry came from China historically. The new leaders will mainly come from where we are, and we are in a good position to become one of them. Though we were born in a small island of Mauritius. Actually, just a story, when we go for some suppliers conference, and I went to New York recently. So I'm sitting across with Indian and Chinese people, and everybody's looking at me. And where do you come from? I say, I come from Mauritius. I say, what? So we are the only one in the industry with the size we have who was born in a tropical island. It doesn't exist otherwise. Nobody was born in a small island. So we've been able to really expand, develop a know-how, and expand it across the different countries. And the fact that we went to Asia a long time ago is really helping us to become one of the big leaders of tomorrow. Thank you.
Thank you, Eric. We have another question from Yakshmi Elapen. Could we have an idea of the manufacturing sectors you are looking at in India?
Yeah. So basically what we want to do is to leverage on the expertise that we have in India in the perspective of building factories, because it's not easy. India is a very competitive market. But at the same time, if we do it, we want to do it in a higher or value-added industries where margins are higher. So we operating in healthcare, manufacturing in India. That's a space where we probably looking at. I don't think that we'll go into the motor industry or whatever it is. That's not our intention. But we want to go in adjacent areas to where we are. So probably manufacturing, healthcare, that's a bit the space in which we're looking to play.
Thank you, Guillaume. We have no more questions from online.
Thank you. Lakshman, I'm going to ask you maybe a difficult question about Bank One. With the regulatory changes you mentioned and the cost of investing into IT solutions, which are extremely expensive, I don't think small banks have a lot of future. So Bank One remains quite small. So how do you see the turnaround for Bank One? When and how?
Thank you, Stéphane. When I hope as soon as possible. We are still confident that we can turn around Bank One to higher profitability. It's profitable. It has a very decent return on equity, north of 15%, which is very decent for a banking institution. As you rightly pointed, financial services, more specifically banks, are being disrupted by technology, and we need to embrace that. So that will be the trajectory of Bank One. We've started. POP was launched about 2.5 years back, still trying to make its mark, hopefully to be consolidated and being more digitalized in terms of the offering to the market. For the rest, I think it is a matter of strategic direction, being strong in our chosen segments where we really want to expand. And as we've seen for the banks in Mauritius, generally speaking, the cross-border revenue stream is fueling the growth. With our partners in Bank One, INM, headquartered in Kenya, we are very confident to unlock more of Africa opportunities, and this is where the focus will be. The tagline of Bank One is still to grow in sub-Saharan Africa with a sweet spot for East Africa. And it reconciles with what Guillaume has said earlier on. Our focus is in East Africa. So it aligns to our group aspirations, but also where we see the opportunities for Bank One. Domestically, we will bat against the best, but I do think the growth opportunities will be more the cross-border portfolio.
Thank you.
Hope I've answered your questions.
No more question? Good, so I would like to thank all of you for coming on a Monday morning, fresh, and wishing you all a great week ahead with all the results. The market will be moving in all directions, so good luck, and Yeah, hopefully one direction. Yeah. Good. Have a good week. Thank you very much. Thank you. Goodbye. Yeah, there's some coffee and tea and downstairs. Thank you.